40% of all houses are free and clear. Guess what? People who own their house free and clear tend not to go into foreclosure. Imagine that, okay? So we've only got 60% of the housing market to worry about. Are they overleveraged? Have these loans been poorly underwritten like they were coming into the Great Recession? Are these people overburdened in terms of their mortgage obligation?
Welcome to the stage, Jason Hartman.
Hey everybody, thank you very much. How are you loving this awesome conference? What do you think? Give it up for Bridger and Mason and the Investment Fund Secrets team. I mean, these guys have just put together a phenomenal event, right? Come on, give it up for them, right? Yeah, absolutely. Absolutely. Well, it's an honor to be here, and I hope I share some good insights with you, good predictions with you. You know, predictions are a difficult business. It's a risky business to make predictions, right? But we'll make an attempt at it today. So let's go ahead and dive in here and take a look. As mentioned, I'm CEO of Empowered Investor, and that's really one of the things we believe in is empowerment. Investors need to be empowered so that they can make the right decisions, avoid blind spots, minimize mistakes. We all make mistakes, but when we do, let's fail forward, right, as the saying goes. So let's look into the crystal ball and see what it tells us about the real estate market, about the macroeconomic issues in general, and where we are going. Is it a red light? Is it a yellow light? Or, of course, is it a green light, right? We got to make some decisions like this. So let me start by pointing out some faulty assumptions that people make when they are looking at the real estate market. These are some of the big blind spots that cause people to make very, very bad decisions. The first one is they make faulty comparisons. They compare apples to oranges, as the old saying goes, right? They don't compare the right things. And these bad comparisons can be extremely costly, right? Yeah, you with me? Definitely. Very costly to make bad comparisons. So today, I will attempt to answer one of life's most important questions. And how many of you saw me speak at the last IFS conference in Utah, right? Yeah, you were there? Good stuff. So there we talked about the compared to what question. And when it comes to real estate, it's just a funny thing to me that people say housing is overvalued. They say that a lot, especially lately. And when they say that, the whole premise of that opinion is based on comparing it to only one thing: dollars. Now, why would you compare something and try to value it based on only one comparison? Especially when that comparison, the US dollar, is a moving target. It's a moving target. So that would be a faulty comparison. Here's another faulty comparison that you're hearing a lot in the media nowadays. People are saying things like, well, compared to 1 year ago, housing is expensive. Or with interest rates going up and prices going up, and of course inflation going up, the mortgage payment is higher than it was last year. Well, of course it's higher than last year, right? It's higher than the year before. I mean, when those first lockdowns lifted and everybody ran out to buy a house and people relocated across the country, I call it the modern day grapes of wrath. As people were moving across the country, they were leaving cities, they were moving to suburban markets, and the market got really, really busy. I mean, it went from nothing during the pandemic to extremely busy, to this red-hot market where we had what we thought at the time were low prices and extremely low interest rates. In fact, the lowest interest rates in, you ready for this one? 5,000 years. Yeah. There are people that actually track interest rates back to ancient Egypt. There's always been a cost of money, right? And there should be a cost of money. There should be an opportunity cost for those lenders. So they make this comparison between the lowest point in history and today. And of course it's more expensive today, but guess what? Back in 2017, people were buying houses, and they thought houses were expensive in terms of price and monthly payment. Back in 2015, back even in 2012, people thought that. I remember our investors, and by the way, what Empowered Investor does is it helps people buy properties around the United States. And back in 2012, as we were a few years out of the Great Recession, and prices looking in the rearview mirror were very, very low, we had all kinds of people that thought we were in a bubble, that thought prices were too high. 4 years out of the Great Recession, people thought, oh gosh, how long can this continue? We've got to be in a bubble. I'm going to wait and time the market, and I'm going to wait till prices come down. How do you think those people did? Not so good, right? So these faulty comparisons are a really important thing. Comparing things to the lowest interest rates literally in history and these extremely low mortgage payments create huge blind spots. So bad comparisons. Now, here's something that's about to happen. We're seeing it happen a little bit now, but it's going to get a lot worse. Okay, and you're going to hear about this in the news media, and it's going to make you think the market is collapsing. Now, maybe it'll be right. I don't know yet. None of us know. But here's the thing that's going to happen. Zillions of people, and this is not an exact number, by the way, don't quote me on the zillions, okay? But zillions of people have gone out and purchased brand new homes. And these construction timelines are very, very slow. With the pandemic, it's created all kinds of supply chain disruptions. By the way, I added that L to the word intentionally. The pandemic, yeah. Folks, we have been had by one of the biggest lies in human history. I mean, it's just unbelievable. Maybe the most important question is, why isn't Anthony Fauci in prison? And maybe Bill Gates too. But anyway, that's another rabbit hole that we'll go down another time. Listen to my podcast for more on that. And they haven't canceled me yet, believe it or not. So what you're going to hear about, all these people have gone out and they've purchased new homes. And the construction is taking much, much longer than ever because of the supply chain disruptions, the labor disruptions. The typical construction worker now is over 50 years old. Can you believe that? There is a giant labor problem in the construction industry. It's a terrible problem. So the building process has slowed dramatically. And as it has slowed, these new homes are taking a lot longer. But guess what? A whole bunch of people went out, they purchased new homes, they got pre-qualified for a mortgage at a much lower interest rate. And these people cannot lock that interest rate in for as long as the construction cycle goes. And guess what? Lenders are not even honoring the rate locks. They are sleazy, unethical lenders that are just finding reasons to deny loans with well-qualified borrowers because they don't want to honor the rate lock. So there will be a lot of cancellations in terms of new homes, a lot of builder cancellations. And the media will report this as though the market is falling apart. And to the myopic media that operates on little dumb sound bites, that will sound true to you. But what they don't tell you is that for the person that canceled the purchase of that $300,000 home because they could no longer afford it, there's another buyer above them that was qualified for a $400,000 home that might have also entered into a contract with a builder. And it might take 9 months or even a year to build that house, maybe even longer. And they will cancel too. But guess what? people will simply reset their expectations because they have to. There's no other choice. You know, there's an acronym in the investing world. You probably know it. It's TINA, T-I-N-A. It stands for There Is No Alternative. And this is the way the marketplace acts. And so the myopic media will report this as though the market is collapsing. But what will really happen is the buyer above them, if you look up, like the picture, right? The buyer above them will simply move down to the less expensive homes. And they will be forced to adjust their expectations lower. That's the way markets work. We always operate as people in free markets by comparison. We get the best thing we can get at any given time, right? You take that snapshot in time. How much house can I buy? That's what I'm going to buy. So people will move down, and the buyer above will buy that less expensive house that the original buyer couldn't qualify for. A lot more work for the builders, but there's still a market there. So that's important to understand. Now, another faulty belief system that goes on in the marketplace is this one. And this is what I love about income property. I say it's the most historically proven asset class in the entire world. Because with income property, it's a multi-dimensional asset class. And we earn our return on investment in many, many ways. So sometimes we're in a capital appreciation market. And that's what everybody mistakenly calls a good market. How's the market? Oh, it's really good. Well, that's because prices are appreciating really quickly. Well, it's not so great if you're a buyer, but it's great if you're an owner or a seller, obviously. But as Marie Antoinette said, there's no bread, let them eat cake, right? And so the modern version of this might be, well, they can't afford to buy, let them rent. That's what people will simply do. And that puts upward pressure on rents. So when the buying market cools and people are priced out and housing affordability is low, people rent. They simply make another choice. It may not be their favorite choice, but they make another choice. Markets are dynamic and markets react. Okay, now, people, they like to use this phrase. Here's the phrase. You ready for this one? I'm sure you've used it yourself. How many of people have used this phrase, the housing market? Right? We've all said that, right? Well, in a country as large and diverse as the United States, there is no such thing as a national housing market. There are almost 400 MSAs, or metropolitan statistical areas. There are over 3,000 counties. There are over 9,000 cities. Tell me where the housing market is. Is it in Los Angeles, where I grew up? Is it in Miami? Is it in Detroit? Is it in St. Paul, Minnesota? Is it in Dallas? Is it in Las Vegas? Well, the answer is it's in all those places, and they all act very differently. There's no such thing as a national housing market. But you can categorize markets into three major types. And here they are. And we're going to talk about this a little bit, so you don't make the mistake of thinking the housing market, because if you listen to the media, they just talk about the housing market as though it's one monolithic thing. There are linear markets. These are these steady, profitable markets. And we like these markets the best. There are cyclical markets. Now, these are markets that if you're looking at an appreciation chart, they look like a roller coaster, big ups and downs. There are hybrid markets, which, as the name would imply, are in between the two. So here's an example of a linear market. We've helped hundreds of investors buy in Memphis, Tennessee over the years. This is a great cash flow market. It has a high renter population. We love it. It's been great. I've owned many properties there myself, and a lot of our clients have purchased in Memphis. But Memphis is a very boring market. It's very linear. If you're looking at a price chart over time, it just kind of chugs along and it appreciates slowly. It's got some downturns, it's got some little ups, but overall, it's very linear. Here's another market where I've helped hundreds of investors buy in over the years. Indianapolis, boring market, okay? The most exciting thing that goes on there is the Indy 500. But great cash flow, nice, slow, steady appreciation. Now let's compare that with a cyclical market like the one I grew up in, Los Angeles, California, my hometown. Look at this chart. It's all over the board. It's like a roller coaster. It's got glorious highs. It's got really ugly lows. It's up, it's down. It's crazy, and it can't be predicted. So this kind of market also has very bad cash flow. Now, time permitting, I'm going to talk to you about something it took me 19 years to discover, and it is called the Hartman Risk Evaluator. And I created a new little phrase when I came up with this idea, and it's called the LTI ratio. Now, you've all heard of the LTV ratio, the loan to value ratio, but this is the land to improvement ratio. When you're buying a property, remember, you're always buying two major components. You're buying land, and you're buying the improvement, or the house, the apartment building, the office building sitting on that land. Here's the common characteristic of linear versus cyclical markets. Linear markets have cheap land. Cyclical markets have expensive land. And if you want to be in a volatile market with bad cash flow, it will have expensive land. This is always true. It's true around the world. Linear markets in the United States are most of the country. They're what Hillary Clinton calls the flyover states, right? So derogatory. That's where most of America lives. But, you know, this is all linear. Most of the world is a linear market. Very few places are cyclical markets, yet because they're interesting and exciting, they get all the media attention. So around the country, the cyclical markets are places like the west coast of the United States, the expensive northeastern markets, New York, Boston, Washington, D.C., South Florida. I live in Palm Beach, Florida, so Miami, very cyclical market. Around the world, there are these trophy cities like Paris, London, Dubai, Hong Kong. Those are all cyclical markets. But the rest of the world mostly is pretty linear. That's how the world works, mostly a linear market. Now, will the housing market crash? Will houses get underwater? Well, the answer is definitely yes. At some point. The question is when, okay? And we'll try and answer that today, but it's a pretty hard question to answer when you've got a centrally planned economy, when you've got the government and the Federal Reserve causing all of these market distortions. It makes the prediction business very, very difficult. So, where are we now? Let's take a look at where we are now. So last year, the typical homeowner gained about $57,000 in equity in their home. And that was about a 31% increase, totaling about $3.2 trillion in new home equity. So that's got a big wealth effect, of course. Okay, great. Now here's another thing to note when people are talking about the potential of a market crash. Nearly 40% of all houses are free and clear. Guess what? People who own their house free and clear tend not to go into foreclosure. Imagine that, okay? So we've only got 60% of the housing market to worry about. Are they overleveraged? Have these loans been poorly underwritten like they were coming into the Great Recession? Are these people overburdened in terms of their mortgage obligation? We started off the year with the lowest housing inventory ever since they've been tracking this stuff. We had the lowest housing inventory ever starting off the new year. And I talked about that and made some predictions in a speech I did in Houston. And we had less than 300,000 units for sale at that time. And as everybody was talking about how the market is so overvalued and it's going to crash, guess what happened? Housing inventory went down more to 241,000 units. Now recently it has ticked up just a little bit. This is 2-week-old data, pretty much, okay? So housing inventory is still extremely low. Now, the experts will tell us that a normal market, is 1.5 million normal to about a lower end of normal, about 1.2 million units for sale. How we doing now? Inventory is very low. You tend not to have housing crashes or crashes in any commodity when inventory is extremely low, right? Say right, yes. Okay, so it would be like walking into the grocery store and seeing 66 to 80% of the shelves empty. That's what the housing market looks like today. Now, just watch the inventory numbers over time, and as they start to tick up, start to be concerned about the housing market and a downturn. But we are a long, long way from a normal market, much less a bad market or a seller's market or a buyer's market. Okay? All right. So, at the beginning of the year, I predicted we would see prices increase by 12% this year, and I'm sticking with that. We'll see if I'm right or wrong. I think I'm going to be right. And I also predicted that rents would increase by 8% this year. Think about how significant that is. If someone is paying $2,000 a month in rent now, they're going to pay $2,160 in rent by the end of the year. Rents are going up very, very fast. And another faulty perception people will have is they'll say, well, look, if prices go up so high, if rents go up so high, who's going to be able to afford it? Nobody will be able to afford it. But that is a mistaken idea, because what always gives in a market where prices are increasing rapidly is the standard of living. The standard of living, the quality of life, is what takes the hit. Now, this is unfortunate, but it's just the reality. It's just the way it is. So here's an example. About 3-4 weeks ago, I went to Zillow and I looked up what $1 million would buy in Jacksonville, Florida. That's a market we do business in. We've done business in Jacksonville for a long, long time. And for $1 million, you'll get almost 5,000 square feet. You'll get this beautiful home. I mean, it's gorgeous. I don't know if it's sold yet. I should probably go and look. But how do you like this property? Pretty nice, huh? Yes? Yeah. Okay. So pretty nice. Look at this. I mean, beautiful house, marble floors, Palladian windows. It's a really nice property. Okay. Well, guess what? If you had that same $1 million and you took it to New York City, this is what you'd get. 653 square feet. They call it 1 bedroom, 1 bath, but it's not even 1 bedroom, 1 bath. It's like a little loft over the little tiny kitchen. You got like this mini dishwasher, and then they say you've got this balcony with a great view. A single chair out there in the balcony. I mean, I don't know, this seems like, I used to have a big motorhome years ago, and I don't know, it's about the size of my motorhome, okay? So the point I'm making here is this. When times get difficult and things become unaffordable, everybody just has to capitulate. They have a lower standard of living. They have to take less. That's reality. It's not like they don't do anything. You know, yes, some people sadly become homeless, right? But most people make the choice between renting and owning. That's what they do. That's just reality. And they just have to rent less or own less. That's how markets work. They don't get this anymore. They get that little crappy place in New York City. Now, as real estate investors, it's important to understand what we're really doing. And here's what I mean by that. I created a strategy about 18 years ago that I call packaged commodities investing. Because as real estate investors, remember those two things we're buying, land and improvement? What we're really buying mostly when we invest in linear markets, because the land is very cheap and the improvement sitting on the land is a bigger part of the equation, is we are buying commodities. What are the ingredients of a house or an apartment building? Well, they're lumber, they're petroleum products, copper wire, glass, steel, concrete, and labor and energy in general, right? This is what we're really buying. But if we went to the commodities exchange and bought these things, we wouldn't get a 30-year fixed rate mortgage at still, even now, historically low interest rates. We wouldn't get fantastic tax benefits. We wouldn't get my strategy that many of you know about that we don't have time to discuss too much today, inflation-induced debt destruction. We wouldn't get all these great things, but because we buy our commodities and we put the real estate label on it, we get all of these wonderful multidimensional characteristics that make income property the most historically proven asset class in the entire world. Now, here's another faulty perception. People like to think, well, there's going to be a glut of housing on the market. Houses have gotten so expensive that people will not be able to afford them. That's not true. It's simply not true. Maybe they won't be able to afford to buy new houses today or in the future, but guess what? The tens of millions of people who bought a house at the most historically, the lowest in 5,000 years, and the tens of millions of people, basically the whole country almost, that refinanced their house, guess what they're going to do? They don't even know it yet, but they have an asset that is so, so valuable. Look at, what makes anything valuable? Scarcity and utility. Those are the two drivers that make anything valuable, whether it be precious metals or cryptocurrencies or real estate or your significant other or your children or your pet. A lot of you saw me here with my dog, right? Who goes a lot of places with me. So what makes something valuable is its scarcity. If it can't be replaced, it's valuable. If it has utility, it's valuable. These mortgages at these low interest rates cannot be replaced. And people will hoard their houses. They will do whatever they can to never sell those houses. They will not go up for sale. And this will be the seed of an ongoing, persistent housing shortage years into the future. The Federal Reserve has basically put a poison pill into the housing market. And this is it. And almost nobody but yours truly is talking about it. A couple people are starting to, I've noticed lately. They probably listen to my podcast. Okay. So what will they do? They'll keep their houses, but they'll improve them. They'll add on. They'll add a room. They'll fix them up. So the home improvement business is going to be a pretty good business going forward. If you're in that business, or if you own stock in Home Depot or Lowe's, it's probably not a bad idea, okay? Because there is going to be a lot more home renovation, and there has been a lot, coming out of the pandemic. Okay, so another faulty thing people do is they don't use the right measuring stick. Like I said at the beginning, they only compare the price of housing to one thing, US dollars. Huge, huge mistake. So let's compare to some other things. Now, I say this thing all the time. I say, compared to what? That's, I think, life's most important question. And I remember my girlfriend at the time, 2 years ago, she used to throw this back at me. I'd say something and she'd say, compared to what? Anyway, don't do that to people. But it is a good question. And my listeners even call it the Jason Hartman question. Clearly, I did not invent it. But it is a very important question. So I created an index, the Hartman Comparison Index, that compares the price of real estate to a whole basket of things. Now, there are so many of these things. In the interest of time, we really don't have time to go through them all, but I just want to tell you I'm going to flash a bunch of numbers on the screen. I know you're going to try and take pictures of it. You can just get these slides. I think Bridger and Mason might offer the slides, but just in case, you can get them at jasonhartman.com/slides, okay? And what you'll see up there is a talk I gave last weekend, but in a couple days we'll put these new slides up there so you can get both sets if you want, jasonhartman.com/slides. So let's compare the price of housing to gold, okay? Let's go back maybe 22 years and look at the year 2000. If you wanted to buy the median price house in 2000 for $147,000 when gold was $283 per ounce, it would cost 520 ounces of gold to buy the median price house. Now, I know you can't see it quite at the bottom because the slide's cut off a tad, but today, at the end of the first quarter of this year, the house price was about $357,000, which everybody thought was so expensive, but it would only cost you 184 ounces of gold to buy the house. 520 ounces 22 years ago, 184 ounces today. So I ask you this question. Priced in gold, is housing cheap or expensive? Come on, yell it out. It's cheap, right? But everybody thinks it's so expensive. Well, let's compare it to more things, okay? How about Bitcoin? Well, in Bitcoin, it's super cheap, right? And Bitcoin's not old enough to go back very far, obviously. It's only a teenager. But, it only takes about 8 Bitcoin today to buy a house, somewhere around there. It's very volatile, so it changes a lot. So priced in Bitcoin, cheap or expensive? Cheap. Okay, good. Okay, what about oil? Oil is one of the most important commodities in the world. I don't care what the tree huggers say, the world runs on oil. It does not run on wind and solar, at least not yet, right? So 52 years ago, if you wanted to buy a house in oil, say you were an investor and you invested in oil, right? That was the commodity of choice. You loved it. In 1970, a house was only $23,000. Oil was $4 a barrel. It would cost you, if you wanted to buy a house, you'd have to convert 6,400 barrels of oil to dollars and then buy the house. Today, you'd only have to convert 3,300 barrels of oil to buy a house. So priced in oil, is real estate cheap or expensive? Cheap, right? You still think it's expensive? I could go on and on because the Hartman Comparison Index has a ton of these things. How about rice? Rice is the base food of 2/3 of the human race. This is an extremely important food commodity. In 1970, 52 years ago, it would take 43,000 hundredweight units of rice to buy a house. Today, only 22,000. Priced in rice, is housing cheap or expensive? Yeah, isn't this amazing? See, in the marketplace, people simply go out and constantly make comparisons. Billions of little decisions happening all the time. How about the S&P 500 index? Our last speaker was talking about that, right? So in 1970, 52 years ago, a house was $23,000. A share of the S&P was $92, 249 shares of the S&P to buy the median price house. Today, only 79 shares of the S&P to buy the median price house. So priced in the S&P 500, is housing cheap or expensive? Cheap, right? And sometimes these aren't the cheapest they've ever been in history, but they're still historically pretty cheap. Okay, we could go on and on. Now, what about median income? Well, in median income, it's actually gotten a little more expensive, okay? So, back in 1970, 2.6 years of median income to buy a house. Today, 5.2. Now, it's not extremely expensive in median income compared to the last few years, but it is more expensive. But guess what? Most people, and I won't go into copper, you can look at that on the slides, okay? Most people don't buy a house based on the price, they buy it based on the payment, right? Okay, let's look at the mortgage payment on the median price house. In 1970, the mortgage payment was $127. Adjust for inflation, today, that mortgage payment is $195, based on the fake official CPI, Consumer Price Index numbers for inflation. But of course, we all know this is a complete scam, right? How many of you think the CPI is a scam? Yes, it's a total scam. So the CPI is a highly manipulated index, especially around 1980 when they really started manipulating the heck out of it. The three major ways they manipulate the consumer price index is weighting, substitution, and hedonic indexing. So I don't have time to go down that rabbit hole today. A lot of you probably already know that, but check out my podcast or YouTube channel for more details on all that stuff. In fact, I did a great video with Bridger, our wonderful host today, that got almost 1 million views on YouTube, and that's the top video on my YouTube channel. So you can check that out where we talk about this, and it's like 50 minutes long. We go in depth, okay? But shadow stats, how many of you have ever heard of shadow stats? John Williams, right? He's been on the podcast, and he calculates inflation the old way, the way they used to calculate inflation. And based on the old way of calculating inflation before 1980, the mortgage payment today is only $58 a month in $1970. So adjusted for real inflation, is housing cheap or expensive? Cheap. I know. We all think it's expensive because of all these blind spots that are going on. It's just not nearly as expensive as people think. How about the mortgage payment in ounces of gold? Look at the column. It's only 0.8 ounces of gold, some of the cheapest it's ever been. Okay? In barrels of oil, if you want to pay your monthly mortgage, it's only 17 barrels of oil today. 52 years ago, it was 36 barrels of oil. Cheap or expensive? Cheap. Not the cheapest ever, I understand that, but still historically pretty reasonable. How about the mortgage payment in shares of the S&P? Look at the chart, right? 1.4 shares in 1970, 0.6 in 2000, 22 years ago. Today, only 0.3 shares. Really, really cheap in shares of the S&P. How about average hours worked? How long does the typical person need to work to pay their mortgage? Today, they got to work a little longer. It's gotten more expensive in hours worked by a little bit. It's not terrible, but it's a little bit more expensive because the typical American worker is getting completely screwed when it comes to their raises. They're not keeping pace with inflation. And that's why all of you are not going to tolerate that. You're entrepreneurs. You're going to make your own income, right? You're not going to depend on the cost of living increase. But 55 hours a month needed of work to pay the mortgage, okay? All right, so the Hartman Risk Evaluator, I don't have time to go through this too much, but basically the concept is land to improvement ratio, or LTI ratio. And I tell the story about a house that I bought back in 2005 or so, and we look at the cost of all the construction materials versus the stated rate of inflation. This was the house I bought. Now that's a picture of my old dog just for fun because he was really cute. And I bought this house, and when I got the tax bill, the tax collector showed me the land value at about $660,000 and the improvement value at about $160,000. I paid $815 for the house, so roughly that's the numbers. But here's the thing on the risk evaluator, it's this. When you buy in high land value markets, this is what happens. $815,000, 19% of that house was improvement, 81% of that house was land value. And then the house went up in value to $1.3 million. I was so happy I couldn't believe it. In 1 year, it went up by $485,000. Here's my question for you. What went up? Which component of those two components? The improvement value, the house sitting on the land, or the land itself? What went up? Who votes improvement? The house, the construction materials went up in price. Anybody? Okay, who votes land? Land, yeah, most of you already get this stuff, right? Okay, so the land value is where most of the appreciation came from. But guess what happened? The house then went down in price. Where did the decline come from? Did it come from land or improvement? It came from land. And this is why the cyclical, high land value markets are much more risky. Remember we looked at that chart of Los Angeles, my hometown, and it was up and down and up and down. Crazy roller coaster ride, right? Very risky market, those cyclical markets. So that's the evaluator. Lots more on that on YouTube and podcast. But here is an overall comparison for you. If you compare things to 1970 and you compare them to the year 2000, of course we could pick any year. I completely get that. Overall, housing is cheap compared to all of the major things in the Hartman Comparison Index for 52 years ago and 22 years ago. Housing is more expensive than it was a year and a half ago. No question about that. But guess what? 4 years ago, 5 years ago, 10 years ago, people still bought houses. It's not the cheapest ever. It's more expensive than it was. But we got spoiled during that historic time about a year and a half ago. Housing was just abnormally cheap. It's not as cheap as it was, but still historically, when you back up from the painting and look at the macro picture and look at the big view, housing is still actually pretty cheap. So if you're looking for a crash, ask yourself, compared to what? That is life's most important question. And I challenge you to use this question in other areas of your life. It's a really important question. So, action items for you. You got to have the right philosophy when it comes to investing, when it comes to thinking about economics and thinking about valuations. So hopefully I've imparted some of that to you today. You got to invest in obviously the right assets, and you've got to have the right capital stack. I didn't get time to talk about that very important strategy of inflation-induced debt destruction, but more on that video I did with Bridger, we really went into that in a lot of detail, and it's right there on YouTube for you to see. And then, of course, you've got to invest in the right markets. So right now, I think we've got a green light in terms of real estate. It won't last forever. I think we've probably got another year or two of very positive market, and the right markets are those safe, good cash flowing, linear markets. Really the markets we've always liked, the markets we've always helped people invest in nationwide, those good, solid, linear markets. And I just want to say thank you again and wish you all happy investing. You can get the slides at jasonhartman.com/slides. Thank you to Bridger, Mason, and the entire crew. Happy investing, everybody.